The US yield curve is doing something extremely strange. This is what the yield curve normally looks like, but this is what it has looked like for some time now. Even more interesting than that is the fact that over the last couple of months, this has been flattening. The yield curve has been uninverting. But the reason why that's strange is because the way it's been uninverting is different than any time it has uninverted in the past. And on top of all of that, recently, because of the fall in long-term interest rates, the yield curve has actually been re-inverting yet again. So why is this happening and what does it mean for you? First, we have to explain exactly what the yield curve is. The yield curve is very simply just a visual representation of how much debt costs compared to how long it is until that debt matures. In a normal environment, a longer term debt would have a higher interest rate than a shorter term debt. Consider the difference between 30-year mortgages and 15-year mortgages. You will get a better interest rate on that 15-year mortgage because the amount of time before that debt gets paid off is less. From a lender's perspective, the risk and the opportunity cost increases the longer that debt exists for. If I know you're going to pay me back tomorrow, I may not ask for any interest rate at all. But if I know you're not going to pay me back for 100 years, well then there's all sorts of stuff that could go wrong in between now and then. There's all sorts of inflation rates that could happen between now and then. The risk is much higher. So me as a lender, I will probably demand a higher interest rate. And that is why the yield curve normally looks like this. The shortest term debt has the lowest interest rate and the longest term debt has the highest interest rate. But the yield curve has not looked like this for some time now. In fact, it has looked like this, which is called an inverted yield curve. This is where the debt at the shortest end of the curve that matures in the shortest amount of time has a higher interest rate than the debt that matures at later times. Now, there is disagreement about which parts of the curve are most important to pay attention to because historically, the inverted yield curve is a sign of a coming recession. In fact, the last 10 times that the yield curve has inverted, a recession has followed 8 times, which means there are some times when the yield curve inverts in which a recession does not follow, but every time a recession has happened, it has been preceded by an inverted yield curve. The gold standard to look at in terms of an inverted yield curve is going to be the difference between the 2-year government treasury and the 10-year US government treasury. This is a chart that plots the difference between the 10-year and the 2-year. Whenever the blue line gets below the red 0% line, that means that the 10-year is paying less than the 2-year. In other words, the yield curve is inverted. However, if the blue line is above the red line, then the 10-year is paying more than the 2-year, which means we have a normal yield curve. Zooming in, we can see that in June to July of 2022, the yield curve inverted and has stayed inverted since. Now, the Federal Reserve has stated that they don't like looking at the 2 and 10 yield curve, but instead they like to look at the difference between the 3-month and the 18-month. But it doesn't actually matter which one of these you look at because right now, the near-term forward spread is also inverted. So why is an inverted yield curve a leading indicator of a recession coming soon? Well, there are 2 reasons. One of them has to do with Federal Reserve intervention, and another one has to do just with free market dynamics. If the economy is expected to get bad enough by the big institutional players, the banks, the people who are buying and selling massive amounts of bonds, and they look at the economy and expect it's going to get pretty bad, they will also expect that the Fed will cut interest rates as a result of the bad economy. Historically, for the last 20 plus years, every time the economy hits a recession, the Federal Reserve is going to lower interest rates to try and soften the blow. And so big bond traders are going to anticipate this. And if they see signs of economic hardships on the way, they're going to front run the Federal Reserve. If I know the Fed is going to cut short-term rates, I'm going to buy those bonds because that'll allow me to have capital gains. On top of that, institutions will typically seek US treasuries as a safe haven. So if the economy looks like it's going to get bad, you're going to sell equities, move over to long-term bonds, which means you're going to get a bunch of buying pressure on the bonds at the long end of the curve in anticipation of the Federal Reserve's future cutting of rates and an expectation of a flight to safety. That will push rates down at the long end of the curve, which will make the curve look like this, inverted. But this can even happen without an expectation or without direct intervention of Federal Reserve. Because one of the things that I'm accomplishing when I'm lending money out is having a return on my capital. I understand that if I get 5% back, but the inflation rate was also 5%, then I got $0 back. Yes, the number of dollars that I have increased, but the amount of stuff I can buy with it didn't change. So my return was actually 0 after adjusting for inflation. If I am trading with anticipation that the economy is going to implode, one of the things that happens during economic hard times is prices fall. Asset prices, goods and services, unemployment, a general depression of economic activity. So hypothetically, if I loan out $100 and then I get $100 back 1 year from now, but the price of everything fell during that time by 2%, then adjusted for inflation, negative inflation, which is really deflation, then I would have gotten a positive 2% real return on my money. Yes, I have the same number of dollars, but I can buy more stuff with those dollars. In this way, lenders are able to accept a lower and lower return on future debt in anticipation of prices falling. And that is how you can get an inverted yield curve as a result of an expectation of an economic crash coming soon, because people become lenders. In other words, they buy longer term debt, driving the price up, which drives the yield down, and they're okay with accepting that lower interest rate because they're expecting that prices will go down in that amount of time. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. They're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. Okay, so at this point we understand that yield curves invert before the recessions hit. But one thing that most people don't know is that the yield curve usually starts to flatten or uninvert right before the recession actually starts. This is a chart of the federal funds rate. This is the only interest rate the Federal Reserve actually controls. You can also see all of the gray bars on this chart, which represent recessions. One thing you'll notice is that since the 80s, the beginning of the gray bar or the beginning of the recession is marked by the introduction of lowering interest rates. In 89, when they started to lower interest rates, a recession followed. In 2000, when they started to lower interest rates, a recession followed. In 2007, when they started to lower interest rates, the recession followed. In 2019, when they started to lower interest rates, a recession followed. Looking at an inverted yield curve, this would look like the short end starting to come down, which means that once the inverted yield curve starts to flatten and uninvert, that is the signal that the recession is imminent. But that is not the only imminent recession indicator associated with the yield curve. This is a chart that shows both the federal funds rate and the 2-year treasury rate, with the orange line being the federal funds rate. What you'll notice is that typically the 2-year moves first and then the Fed funds rate follows. In 2000, the 2-year started to fall, and then in late 2000, the Fed funds rate followed. In 06, the 2-year started to drop, and in 07, the Fed funds rate followed. In November of 2018, the 2-year started to fall, and in July of 2019, the Fed funds rate followed. Zooming in on the last couple of years of what the 2-year yield has done, we have not yet seen a decline in the 2-year, which would also indicate in the next next couple of months, the recession is not likely to start quite yet. However, prior to every past recession, the yield curve has uninverted as a result of the short end getting pushed down. This time, the yield curve started to uninvert as a result of the long end rising, which has never happened before. Over the last 1 year period, the 30-year US Treasury, which is at the longest end of the curve, has risen from a bottom of 3.4% up to a height of 5.1%, versus 6-month T-bills at the short end of the curve have risen from 4.57% up to 5.44%, which means that the yield curve has been flattening, moving on its way towards being uninverted, being a regular yield curve again, not as a result of the short end going down, but as a result of the long end going up much faster than the short end has gone up by. This is unprecedented, and it has never happened before. I've made quite a few videos over the last couple of weeks explaining the situation of US government borrowing and how that will accelerate, and that will also lead to accelerating inflation. So if you want to know more about why the long end of the curve was rising and flattening the yield curve, I recommend checking out those videos. But now we have to take a look at the strangest part about this whole story, and that is the fact that it looks like the yield curve is starting to re-invert yet again. 30-year US Treasuries have moved from a high of 5.17% down to a low of 4.6% in the matter of a few weeks. Short-term US government debt, like 6-month T-bills, have dropped a little bit as well, but for the most part have stayed flat, relatively speaking, of course. So why is this happening? Well, it's mainly being driven by inflation expectations cooling, with the October inflation reading coming in at 3.2%. This is the lowest reading since July of 2023. Essentially, this is a short-lived rally in bonds as an expectation that the Federal Reserve has beaten inflation. And if inflation numbers are going to be falling in the future, then me as a lender, I'm okay accepting less and less as a return on my debt, just like I explained earlier. But in my opinion, this rally in treasuries, allowing yields to drop, is going to be extremely short-lived. Why is that? Because the inflation data is crazy. I'm sure you saw this going around the internet, but if you take a look at the breakdown of what the Bureau of Labor Statistics shows about prices in each category, you'll see that they show health insurance has dropped by 34%. Did your health insurance drop by 34%? Let me know in the comments how much your health insurance premiums dropped by over the last 12-month period. The drop in CPI was also led by a plunge in energy costs, which is also a leading indicator of recession to come. Simply, people are spending less money because they have less money to spend. It's not a sign of economic growth. And given the fact that the federal deficit is increasing, tax revenues are declining, borrowing is skyrocketing, and interest payments are quickly becoming the largest category of government expenditures, it is safe to assume that government borrowing, the appetite, has a very good chance of outpacing any potential appetite for lending to them, which means I expect interest rates to continue to move upwards over the long term. And finally, I understand that it can be very difficult to understand how to play these scenarios. Do I keep on buying just because everybody else is? The market is skyrocketing higher, ignoring the fundamentals. But if I buy, then I'm buying at the top right when things are about to crash. Or do I do the opposite and try and bet on things falling and then just miss out if I'm wrong? Well, that's exactly what Heresy Financial University is there for, to help active investors like you position your portfolio in a way where you can make money in up or down markets with limited risk. And right now for Thanksgiving through Black Friday, I've got a very special discount. If you join with the annual plan and you use coupon code Thanksgiving, you'll get your first year half off. Now, the annual plan is already discounted compared to being on the monthly plan for a year, but just for Thanksgiving and Black Friday, if you use code Thanksgiving, you get the annual plan for the cost of only half the year. This is a screaming deal. It will not last. The code will no longer work after the night of Cyber Monday. The link is in the description below. Choose the annual plan, click join now, type in the code Thanksgiving, hit apply, and enjoy your first year half price. As always, thanks so much for watching. Have a great day.